Hello everyone and welcome to your Glassnode video report for week 35, 2023. Today we are doing a deep dive on exchange risk, and really this is kind of coming off the back of many of the lessons learned and kind of time we've spent studying the FTX event, where really the digital asset market learned in a very painful lesson that counterparty risk remains. Now, for many of our clients, when we're trading and using these exchanges, there is always going to be that counterparty risk. And in many ways, we've got lots of tools to help understand when there may be kind of things that just look a little bit out of balance, potentially times where risk mitigation strategies and capital preservation may need to step in. So what we're going to do is explore this through the lens of, using FTX and a couple of other exchanges as case studies, just to really understand a couple of these different metrics, a couple of frameworks for how we can think about exchange and counterparty risk, and really what we can do to try and just identify and spot those particular kind of events that are just out of the ordinary. So counterparty risk, and when exchanges, the hard reality of this industry is that assets need to be held at some kind of a custodian. And obviously these custodians come in varying degrees of quality. As we found out with FTX, unfortunately, things do go wrong. And this is a lesson that has been learned many times. The Mt. Gox event back in 2013, and there's been many of those such events since. So what we're going to look at today, we're going to start off with a bit of a general view and just get a bit of a sense of scale for how large exchanges are, and really just paint the picture that they really do remain the centerpiece of liquidity for this market. And what we're then going to do is we're going to introduce three different metrics or three different ratios or indicators across the four top assets: Bitcoin, Ethereum, USDT, and USDC. This is really where the primary majority of the capital in this space really exists. And just look for some of these indicators across four exchanges: Binance, Coinbase, Huobi, and FTX. Essentially just selected so we can get a bit of a view of different types of exchanges and what some of these indicators may tell us. Some of them have some nuances, and we're just going to bounce around these ideas and just kind of talk it through. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. Really do appreciate it. Let me know if you have any comments. And just as a reminder, these particular metrics will be available because we're looking at the actual exchanges themselves. And this is really taking advantage of, kind of the top level of Glassnode's labeling and entity analysis. We're going to be looking at internal exchange transactions, exchange to exchange, really leveraging all of the benefits of our entity adjustment and our exchange wallet clusters. So really getting into some pretty impressive work that the data science team is consistently building. So we'll be building on top of those. Now, just before we get stuck into the analysis, if you did miss it, we released a video last week covering that kind of an initial introduction to Cointime economics. This is a white paper that was developed between myself and Dave Puel from ARK Invest. So it was a joint venture between Glassnode and ARK. And this really is, this has been about 18 months worth of work. So if you haven't seen the Cointime economics piece, please do jump across to our landing page. You'll find a link in the description below. And this is really a new economic framework for Bitcoin. It is kind of the amalgamation of lots of interesting work, kind of lateral thinking, and really correcting many of the on-chain metrics that have been drifting over time. It really is a bit of an insight from a new lens that links the dimension of investor holding time to the coin supply. So really coming quite interesting, certainly something out of left field, but I do recommend, if you haven't had a chance, please do jump across and download the report PDF. And as always, looking forward to hearing your comments and feedback. Okay, so getting stuck into the analysis that we're all here for, as I mentioned, we're going to start with the macro picture, and I just want to paint the picture of how significant and meaningful exchanges really are. So quite often people will look at the balance that is on exchanges, and here we've essentially got the breakdown of overall exchange balances, broken up by all the different exchanges themselves. Now, in terms of the general magnitude, right, overall, the trend has been since March 2020, we have seen a net downtrend overall. But really what I want to draw your attention to is that we see with exchanges, as with many things when it comes to supply in markets and populations and all the rest of it, we have a Pareto distribution. You can see down the bottom here, this is Binance, which has the largest balance of the exchange component. And just as a quick reminder, exchange balances do not include things like custodians, right? The likes of holding GBTC and these other ETF products, those kind of institutional custodians, they are a separate set of entities. This is really looking at the exchange, the actual exchange where you can actually, where the trading is actually taking place. That's really what we're trying to capture here. So Binance down the bottom here, we've then got Coinbase sitting on top as the second highest, and then Bitfinex, and then it's essentially a very rapid grading down. So really a huge proportion of the overall kind of balance on exchange liquidity is generally centered around a handful of exchanges. It tends to be a relatively small cohort where most of the capital exists. Now, this is kind of an interesting chart. Again, just trying to put things into a little bit of perspective. What we've got shown here, I might just go on an all-time zoom because it is a nice chart to look at. What we've got here is just kind of showing you a bit of a relative scale, just to get some ideas into your mind. So down the bottom in the gray, this is the circulating supply, obviously. And you can see down the bottom in gray, this is the probably lost supply, the supply that is highly probably lost. Coins that haven't moved since we've had an exchange traded price back here in 2010. So you can kind of get a bit of a sense of scale. It's about 1.45 million BTC. Now, sitting on top of that in the yellow, this is the exchange balance. So you can see it's a meaningful component, but a much, much larger component is essentially held off exchanges, noting that, again, custodians and GBTCs will also be inside the orange, but you can get a bit of a sense of scale. We're talking about 1.5 million Bitcoin that are currently sitting on exchanges. It's around about 12% or 11% of the overall circulating supply. Now, if you can squint hard enough, you can see that little purple layer that's sitting on top. That is the entity adjusted volume that's sitting on top of that exchange layer. And this is, again, just to put a bit of a sense of scale, that's the amount of volume that's transacted every single day. Now, just to be really conscious here, when we talk about transaction volume, at Glassnode, we've got a couple of different versions. We've got our kind of total volume or change adjusted. These metrics are looking at the aggregate, looking at all of the transaction activity. Change adjusted will remove some kind of industry standard heuristics, but for the most part, it's going to capture all of the transaction volume going on. Our entity adjusted volume is really going to move, it's going to ignore and filter out all of the Binance internals, the Coinbase internals, kind of self-spends. It's going to work out when transaction volume is non-economical. And when we're looking at exchange-related data, we're going to be using our entity adjusted volume because it's going to be filtering out all of that noise, and we're going to be comparing apples with apples. We'll talk about this in just a second. But you can kind of see the scale of this. We're talking about a very, very small fraction, about 0.2% of the overall volume. And again, this could include the same coin spending twice if it's going between two different parties, a deposit and then someone else withdraws it. But about 0.2% of the supply moves around on a daily basis, just for a bit of a sense of scale. Now, this here is our entity adjusted volume in orange, plotted out in BTC denomination. And down the bottom here in a stacked form, we've got our exchange withdrawals in red and our exchange deposits in green. So just to put a bit of a sense of scale, you can see that if we take the total height of our entity adjusted volume, about 50%, it's actually 55% as of right now, 55% of all transaction volume, economical volume that's occurring on Bitcoin is either to or from an exchange. And just to really put a pin on this, this is really why on-chain data is so information dense, because more than half of all economical flows are people sending to or withdrawing from an exchange. And each time those transactions take place, all of the on-chain data that we look at, whether it's the age of the coins that are spent, the profit or loss that is realized, all of these components are telling us something about market sentiment. So it really goes to show just how significant exchange flows actually are to the industry. This here, we've essentially done the same chart, but we've combined it. So the blue is now total, just gluing together deposit and withdrawal volume. And then here we've got our actual dominance. And you can see that we're about 54, 55% dominance right now, which is not too far from the all-time highs. You can also see that exchange-related flows is in a very long-term macro uptrend. It goes through its cyclical behaviors, but overall, the amount of transaction volume going in and out of exchanges, it's more than half of all economic flows. So it just puts this thing into perspective that these exchanges really are the centerpiece of the industry when it comes to liquidity and trade volume. And furthermore, this is why on-chain data has such an impressive footprint in terms of the amount of data and information we can extract out of it, because it dominates. So many of these coins are people buying, selling, trading, moving coins around. And again, all of this is going to exist within that, we call it hot supply or short-term holder supply. A lot of that exists within those buckets until it goes to a hodler's wallet and migrates and matures and becomes that long-term holder. So again, just kind of putting a bit of a perspective on all of these things. And the last thing we're going to look at is in terms of the overall fund flow breakdown. So again, in orange, this is basically a dominance chart. In the orange, we're looking at total entity adjusted volume. And again, you can see here in the blue, this is our exchange related at about 55, 54%. Down the bottom here in purple, we have flows that are associated with whale entities. So we're talking about entities with more than 1,000 BTC in terms of their overall kind of entity adjusted volume. So that's looking at how much of the flows going in and out of exchanges are actually dominated by whales. And it sits around 25% if memory serves correctly. And then down the bottom here in red, we have inter-exchange flows. This is Binance to Coinbase, or Binance to Bybit, or Bybit to Huobi. Whatever that exchange may be, the red here is actually showing us how much of that volume is actually dominated by inter-exchange flows. So you can see that the overall picture of funds flowing in and out of exchanges is quite dynamic. And we're going to use this initial breakdown and now step in and look at some potential indicators we can use to try and spot exchange risk. Now, what we're going to do in this next section is really just highlight the concepts, and this can be applied to any exchange. We've used Binance, Coinbase, Huobi, and FTX just as different kind of case studies to understand the mechanics, and each one of those exchanges has a unique characteristic just to help put this into a bit of context. So what we're looking for here is things that just may look a little bit bizarre, right? When something looks a little bit out of whack, and we're going to use FTX as an example where pretty much everything was out of whack, and almost the perfect case study for what not to do, or at least what to look out for. So the first thing we're going to look at is called our internal reshuffling ratio. And what we're looking at here is, let's just take an exchange A. If they are turning over internally lots and lots of coins, let's say, for example, they've got 1,000 Bitcoin, just argument's sake, and they churn over 800 Bitcoin every day, right? They're doing some kind of internal wallet management. Well, in the case of FTX, it turns out this was actually Alameda misappropriating customer funds. So that kind of internal churn of lots of their balance is something to just pay attention to. So what we look at is the total internal transacted volume by their balance. It's basically how much of their overall balance are they churning over on a 7-day moving average basis. So if we look at and we're going to look at this from 4 different assets. In all of these metrics, we're going to look at Binance top left, Coinbase top right, FTX bottom left, and Huobi bottom right. And we're going to look at always Bitcoin, Ethereum, USDC, and USDT, with the color traces being their token. Now, there's a lot of lines here. Let me step through each one. So what this is going to tell us, if we get a high value that's close to 1, all of these are capped between 0 and 1. If we get a high value of 1, right? In the case of Binance here, we get these spikes of orange, spikes of green. This means that 100% of the Bitcoin balance has turned over the last 7 days. Likewise, here we're getting lots of churn over of Tether. If we get a low value, it basically means that it's a very small percentage is turning over. Now, if we look at the FTX case, their Bitcoin balance was essentially churning for a period of about 14 months. They were spending more than their entire balance over and over and over again internally. And this turns out it was actually Alameda misappropriating funds. So we're looking for that kind of strange behavior. So let's go top to left. Let's start with Binance. You can see that typically speaking, we get churn on a couple of assets, typically around volatility, big sell-offs, large market rallies. And if we kind of think about this, there's always going to be some kind of nuance here. You could argue that this is essentially market volatility, lots of people deposit, lots of people withdraw. There's going to be a period where these assets need to be kind of recombined with their cold wallets, their hot wallets need to be sorted out, deposits all get consolidated. During these market volatility events, because there is more market activity, it actually makes sense for this to happen. So it's something to just pay attention to, particularly if it's over a sustained basis, but there are also very legitimate reasons why this may happen. Now, if we look at Coinbase, we can see there's very, very little going on except for USDC. And then we go, okay, well, Circle and Coinbase have a partnership. Coinbase is a primary onboarding venue for USDC. So in many ways, what we're seeing here is that internal churn is very, very likely going to be part of that partnership. It's essentially USDC on and offboarding. So in that instance, it actually does make quite a bit of sense. For FTX, and again, a lot of this is leveraging the lessons learned, right? We've seen what the disaster that FTX was, and we're just trying to propose some different ideas to help spot it to make sure that doesn't happen again. If you look at it from the case of FTX, they were churning their entire Bitcoin balance for about 14 months, and note how it stops when the exchange stops because the coins were gone, right? This is just a very unfortunate reality, but gives us something to pay attention to moving forward. So now if we move across and look at Huobi, we can see similar to Binance, we have these volatility linked events, right? Where we get these kind of wallet churning. So far, we haven't had any sustained periods of uptick. However, what we will note is that it's a little bit more elevated over recent months. We've just seen a few more, as not just Bitcoin, we're seeing it across a couple of assets. You'll see here for Binance, we kind of get these spikes where a bunch of assets churn and then it dies off. For Huobi, it's just a little bit larger at the moment. So it's just something to just be aware of and pay attention to. But we have to remember, for all of these metrics when it comes to Huobi, we are looking at the denominator, which is their exchange balance for the asset. That is in the bottom of all of these terms. And as a result, as the denominator gets smaller, any churn that's going on in the top level is going to be larger. But that in itself, you can see that overall, in terms of the proof of reserves on Huobi, it's just something to pay attention to, that there is in fact a declining overall number of assets available on the exchange itself. So it's just one of those things to keep in the back of the mind, because you'll see that very similar theme where it looks quite similar to Binance, volatility linked, but at the same time, that is partially because their balance has actually been in a fairly long-term decline. Now, the second one we're going to be looking at is the exchange reliance ratio. And the concept here is funds. We saw that inter-exchange flow. Well, let's say you're a very large exchange and someone deposits, 1,000 Bitcoin and you've got 1 million Bitcoin. Well, that 1,000 Bitcoin is kind of small relative to your balance. And if more funds flow from your exchange to somebody else's, it's all relatively small compared to your balance. Nothing to really, kind of be concerned about. If, on the other hand, on a regular basis, a significant chunk of your balance is going to and from other exchanges, it kind of indicates there might be a reliance, right? A smaller exchange, if there's lots of funds flowing to and from a bigger exchange, and it's a significant portion of the small exchange's balance, that may indicate there's a reliance of the liquidity between these two entities. And it may suggest that even that exchange has a bit of counterparty risk going on. So what we look at is the 30-day net flow of the total amount of coins flowing in or out from an exchange and compare it to its balance. Now, this one can trade between +1, meaning that we've got overall net inflows, or -1, meaning that there's net outflows. So again, we've got our same grouping for Binance. We can see that there's periods of time where Tether flows in and Tether flows out. We can see that USDC, interestingly, note that USDC tends to be deposited to Binance really over the last 12 months. And it's actually of a very similar magnitude to USDC being withdrawn from Coinbase. So what this is actually telling us is there is likely a flow of funds of USDC from Coinbase to Binance. Now, the other thing to note is that most of the other traces tend to oscillate around zero, right, for both Binance and Coinbase. And really what this reflects is that these two exchanges are so large and their balances are so big that they're not really reliant on any other exchange. That's really what this is kind of pointing out to. There is a relatively low degree of reliance on the liquidity on Binance to the liquidity of other exchanges, and same for Coinbase. Now, for FTX, we have this very, very angry looking red zone. This is because lots and lots of coins, and you can see this really started up when 3 Arrows blew up back in June 2022. Almost all assets started flowing out and in the wrong direction. So in many ways, this is essentially telling us that there were warning signs as far back as June, which is really when most analysts would say that FTX probably actually blew up, or Alameda blew up, and it was just a very painful process till the final unwind. Now, again, if we look at Huobi, we can see there has been, for a sustained period of time, a relatively significant amount of fund flow. We can see ETH in the background here in purple is starting to see significant outflows towards other exchanges. Likewise for USDC, periods of USDT. So again, it's just one of those things to just be a little bit aware of, that there is, in fact, relative to Huobi's balance, which we saw before is declining, there is a relative amount of funds flowing towards other exchanges, out of Huobi and towards other exchanges. And again, this is just one of those things to just be aware of and just kind of consider it when it comes to counterparty risk. Now, the last one we're going to look at is the whale withdrawal ratio. Again, we're going to put the exchange balance in the denominator. And what we're going to look at is the 7-day flow of funds to whale addresses. So this is looking at whales, people who have more than 1,000 BTC. This is typically trading desks, larger entities, withdrawing funds out of an exchange to their wallet. And let's again just have a look at FTX as a case study. The red curve here is the long-term average, because naturally every exchange is going to have its kind of natural heartbeat. Whales are going to be depositing and withdrawing all the time. So we've kind of got this long-term average as a bit of a, what is typical and normal. Now you can see we've got our gray line up the top here. This is kind of when we start getting into extreme risk territory. For Binance, you can see that, it's got a kind of a bit of a heartbeat, but it generally trades well and truly below the long-term average. For Coinbase, it's nowhere. Both of these exchanges are just simply nowhere near that level. So what we're seeing is that relative to the balance of coins on Coinbase and Binance, the amount of whale withdrawals are relatively small. There's nothing really that kind of sends up any kind of major red flags. Again, none of this is comprehensive. This is just a couple of metrics. There can still be risks out there that we don't cover here. All we're doing is looking at some of the lessons learned from FTX and trying to just paint a picture and turn these into some metrics we can assess and gauge. Now, when we look at FTX, you can see again, here's that June event when the 3 arrows blew up. And the whale outflows blew well and truly above that long-term mean and obviously ended when the exchange collapsed. So we can see there is a non-trivial amount of whale outflows going from FTX. And lastly, just to close out, again, looking at Huobi, we can see that over recent months, we have seen a little bit of an uptick, a notable uptick in terms of whale outflow volumes. It is clearly a break from what we've seen for really since mid-2019. It is not unheard of. We have seen this level before. However, it is just one to be aware of. Let's just quickly zoom back up. So we're looking here at around mid-2019 during the rally. So we can see here that we have a net decline, but we know that our balance is in the process of declining. If we go back to 2019, we can see a similar level, right? In terms of overall volume or balance held on Huobi, we can see that there was a similarly small balance at that point in time. So again, a lot of these things come back to the fact that the denominator for Huobi is quite low, which is the exchange balance, but that in itself is kind of just something to be aware of and cognizant of as we move forward. So thank you for tuning in for that session. Hopefully you found that useful. Exchanges are the centerpiece of this market, and just keeping an eye on these things and understanding exchange and counterparty risk can be useful, right? It's a powerful tool when it comes to risk management, risk mitigation, and what we propose here is just a handful of tools, more of a framework, a way to think about it, and really leveraging some of the examples from FTX. You could really see that FTX stood out across all three of those metrics, and really what we're looking for is just things that warrant that kind of second look, right? It's just a bit of an indicator to show us that something is just a little bit off, and therefore we can just have that extra, extra kind of scope around it. Now, if you haven't checked out Cointime Economics, please do review our white paper. Again, there's a part 1 primer by the ArcSci, which is a bit more of a general overview, and then part 2 is a much deeper dive, really going for on-chain specialists and analysts. Really giving you the full picture, right? Stepping through all of the metrics, all of the constructions, and all of the findings. So as always, I look forward to hearing your feedback. Hope you have a great week, and I'll see you in the next one. Cheers.